Opinions expressed herein are subject to change and not necessarily the opinion of the firm. Past performance is no guarantee of future results. The information presented herein is for informational purposes only and is not intended to provide personal investment advice. It is important that you consider your tolerance for risk and investment goals when making investment decisions. Investing in securities does involve risk and the potential of losing money. The material does not constitute research, investment advice, or trade recommendations.
And now introducing Mr. Keith Lanton.
Hi, good morning again. Welcome to second Monday in August. This morning it is August 10th, 2020. Let me get started this morning. A lot to talk about. Even though we are in the middle of the summer, we've got several factors to focus on as we approach the election. At the same time, of course, we have the pandemic going on, and we have the continuing U.S.-China tensions. So we'll talk about all three of those events and how those three themes and how they influence the markets this morning. First off, though, I'm going to get started by congratulating one of our own, my sister, Wendy Lanton, who was on Friday notified that she had been elected to the FINRA Board of Governors as a small firm governor, one of three. Wendy had run against originally a dozen candidates. That list had been whittled down to three and a runoff took place, and Wendy received the majority of the votes, even though there were three candidates. So congratulations to her. Wendy will be representing not only Herald and Lanton as a small firm on the FINRA Board of Governors, but representing all small firms, and we are proud to have her as our compliance chief. So, getting started this morning, wanted to start out with an article I had read over the weekend that I thought was a good perspective setter. This is an article that was written by Vitaliy Katsenelsen, and he was writing on the current market state where we have a handful of companies, as most market followers know, that represent a large portion of the gains in the markets. Some people call these the FANG stocks. Some people call them the FANG AM, to include Microsoft and Alphabet and Amazon in the list. But nevertheless, we're aware that a handful of stocks, Google, Facebook, Alphabet, another word for Google, Apple, Facebook, these companies now make up a large portion of the S&P 500, 21%. And what does that mean for the financial markets, and what does a large concentration of a handful of stocks historically say about market movements and the future? So if we were to take a look at the FANG AM stocks, as Mr. Katsenelsen has said, we would note that they make up 21% of the S&P 500 now, because the S&P 500 is a market capitalization index, so the larger you are, the more influence you have. So at this point, those companies represent 21% of the returns of the S&P 500. If you were to take a look at the S&P 500, not on a market cap weighted basis, but on an equally weighted basis, meaning that each company in the S&P 500 represents 0.2%, because there's 500 companies in there, then these companies would represent just over 1% on an equal weighted basis of the S&P 500, not a 21% representation. And what would that have meant for returns if we were looking at things on an equally weighted basis? In other words, if we were to take a look at the economy and say everyone is more equal, how have companies done relative to the way it's looked with this market capitalization index? And fortunately, there is a ETF. The symbol of that ETF is RSP, Roger Sam Paul, and this is an ETF that represents the S&P 500 on an equal basis. Again, each company representing 0.2%. And in that scenario, we'll see that year-to-date, the S&P 500 on the market cap weighted basis is down 6%, whereas RSP, the equal weighted, is down 16%. Now remember, in this scenario, same stocks. It's just that the S&P 500 SPY is heavily weighted towards these companies that have brought us into the digital age, and the other companies in the S&P 500 primarily make up what we typically think of as consumer goods and companies in the industrial space, companies that are more likely to require more investment in capital expenditures, meaning building factories, plants, needing salespeople, boots on the ground type businesses. And Mr. Katsenelsen points out that at some point it becomes more and more challenging to have a continuous disconnect between a handful of companies, even though they represent exciting sectors, and the rest of the markets, because the rest of the markets, those companies with boots on the ground, with plants and property and sales forces and representatives in countries throughout the world, those companies ultimately are the customers of the companies that are the companies that have more digital presences. So at some point, if those companies aren't doing so well, eventually that will translate potentially into the companies that represent the digital companies in this era not performing as well historically over longer periods of time once they reach a certain level. Now, we can go look back and we can look at two previous periods of time, Mr. Katsenelsen points out. One is we can go back to the 1960s when we had the Nifty 50 stocks. These were 50 stocks that then at that time were the go-go stocks, perhaps similar to the FANG stocks. It was a longer list than the FANG stocks. But nevertheless, many of those companies, household names, Coca-Cola, Disney, ExxonMobil, IBM, Philip Morris, McDonald's, Procter & Gamble, to name a few, companies like Polaroid, Eastman Kodak, if you remember that one, as well. General Electric, another one, if you remember, also on the list of those Nifty 50 stocks. And if you took a look at that list in the early 1970s, even though many of these companies were fantastic companies, and you look at how they did from about 1972 to 1982, you will see that despite the fact that these companies continue to do good business, in many cases continue to thrive, also, in many cases, they went nowhere for about a dozen years in terms of stock price because the PE ratios were so high that they approached more normal levels. So, for example, McDonald's between 1972 and 1982 was relatively flat. Coca-Cola between 1974 and 1985, flat. Philip Morris or Altria Group today between 1973 and 1980, flat. Disney between 1973 and 1986, flat. General Electric between 1973 and 1982, flat. So you get the idea of what took place in those years there in the Nifty 50s. But we could also take a look at another era and take a look at the 1990s or the dot-com period and draw similar parallels. So, for example, if we were to take a look at a darling today, Microsoft, which peaked, as many of us are aware, in the year 2000, it took Microsoft 18 years, from 2000 to 2018, to get back to even. And as we know, it's since 2018 has exploded higher. We could take a look at Walmart between 1999 and 2013, flat. Walt Disney between the year 2000 2012, flat in terms of returns. So these companies have gone on in many cases to much higher levels. But the question begets itself, would investors, or thinking of yourself as an investor, yourself as an advisor, would you be able to hold on, not knowing that these companies are going to potentially move to new heights? And we could certainly go through a list of many that didn't. But nevertheless, would you be able to hold on for that 10, 15, or 20 years waiting for those companies to recover? And in many cases, just knowing the vagaries of human nature, most people would lose patience in that period and would not have held those stocks coming into the recovery period somewhere in between 2015 and 2018. Also keep in mind that many companies that were in the Nifty 50 or the dot-com darlings didn't make it. So we're just taking a look here right now at the survivors, but you can go back and think of companies like Bethlehem Steel, General Motors, Sun Microsystems, WorldCom, Polaroid, Eastman Kodak, all of which are bankrupt companies, some of which have come out of bankruptcy and exist today, others which have gotten acquired. I will make a correction there. Sun did not go bankrupt, but was acquired at a low valuation by Oracle. Other darlings, just shells of the former selves, GE and IBM. So just some caveats, some thoughts this morning to think about as we're in this period here of a handful of stocks driving the markets higher. Always dangerous, but I will point out what some of the those who are positive on these companies, and I'm not in any way saying I am negative, but the rationale for why this time could be different at the moment. Number one, we are in a different period of interest rates. If you go back and look at those other two periods, we're in periods of significantly higher rates than we're seeing here right now, where we have extremely low interest rates, possibly, arguably, negative real interest rates is one factor that differentiates this period from those two periods. And a second factor that potentially differentiates is that in many cases, many of these companies, when they were in the past, in the 1960s and in the 1990s, when they were being born, these companies, in many cases, the Coca-Colas, the Procter and Gamble's, these companies were coming out with new products and had to populate the world with their products on a boots on the ground basis. Whereas companies, for example, like Amazon, are able to scale their operations to a greater extent, and they've certainly done a wonderful job of creating new markets. But these companies also are in a more winner-loser scenario. And what I mean by that is these companies are not only creating new markets, but are taking share from old markets. In the case of Amazon, taking share from local stores, from companies like Sears and Kmart and JCPenney that weren't able to compete with them. Same goes for companies like Google, Netflix, Facebook. Netflix taking business from traditional movie theaters. Facebook and Google taking business from print, newspapers, magazines that used to see advertising dollars. So not only expanding their markets, but also winning markets from entrenched companies as the world has shifted. So, moving forward, where are we today? What's going on in the world here, August 10th, 2020? Well, first off, we are this morning seeing futures modestly higher. This morning, Dow futures up about 80, S&P futures up about 2, NASDAQ futures actually down 1 point now, Russell futures up slightly, and this as Congress debates a new stimulus package and the uncertainty surrounding whether or not we will see some relief. So I had mentioned at the outset three primary driving factors to try and simplify what's going on in the world, if that's possible. First and foremost, number one, we've got the coronavirus and the uncertainty surrounding that. We've got the questions about the world response, the U.S. response, testing, and we've got the possibility of a vaccine being available and what that will mean for the markets. As a result of the coronavirus, we've had lots of changes in policy, both fiscal policy and monetary policy. We've got the Fed taking dramatic action. We've got interest rates at historic lows, and we've got negative real interest rates here in the United States. All that's affecting gold, affecting the dollar, and affecting the news flow this morning as we see President Trump taking some action over the weekend. And we'll talk a little bit more about that. And we have continuing discussions going on between the Democrats and the Republicans, all that creating uncertainty. Number two, we have the continuation of U.S.-China tensions. These are both political tensions as well as economic tensions. So number one, we've got the trade, which was the original issue, the trade imbalance between the U.S. and China. President Trump making a strong point during the 2016 election and continuing to press the point between 2016 and today, whereby he is discussing the unfairness of the policy relative to the U.S. perspective and how he wants to see that change. Change is always challenging and difficult, and the Chinese have resisted that change. and that has led to significant tension, sanctions, agreements, and whether or not those agreements will hold. Now we see that manifesting itself in Chinese companies doing business here in the United States. The Trump administration applying a lot of pressure to Huawei, and now applying similar pressure to TikTok and to Tencent through WeChat. At the same time, the Chinese have taken a strong position with respect to Hong Kong, and whether or not they will allow Hong Kong to continue to operate the way that the West believes the Chinese promised to operate it through 2047. Just this morning, a high-profile arrest of Mr. Li, who has been an outspoken critic of the Chinese government, further pressuring U.S.-Chinese relations. And then we have Taiwan in the news, U.S. sending its highest representative to Hong Kong in years. And then over the weekend, Hong Kong, when I say Hong Kong, Taiwan, U.S. sending its highest ranking representative to Taiwan over the weekend, and the Chinese responded by flying fighter jets into Taiwanese territorial space. And then finally, we've got the uncertainty about the election. What is the election concerns? Well, number one, there are concerns that the election could be a stalemate, that we could have a situation where the Democrats and Republicans are fighting over the validity of the election. We could have uncertainty on whether or not, as a validity fight takes place, whether or not the current president, if he were arguably found not to have won the election, whether or not he would vacate until results were official, so to speak. We also have uncertainty on whether or not we would have a quick result to the elections, as lots of uncertainty regarding paper ballots and uncertainty regarding electronic ballots. We've seen this happen before in 2000. And then finally, of course, what the outcome of the election is, even if there is no challenges in the interim. We could see lots of different scenarios play out, and we'll talk a little bit about that. Barron's talked about that, and those different scenarios and what they may mean for the markets. So moving on, just to give us a quick snapshot of where we are, and then I'll talk about some news this morning, and then we'll talk a little bit about Barron's. Snapshot where we are this morning. Last week, we saw strong rallies in U.S. markets. Dow up almost 4%, the S&P up 2.5%, the Nasdaq up 2.5%, and foreign stocks were up just about 2%. Emerging markets up 1%. Put things in perspective, year to date, the Nasdaq is now up 23%. The Dow is up down 2.5%, and the S&P is up 5%. So you can really see that Nasdaq outperformance there. Bond market, the Treasury market, 10-year Treasuries up 11.5% year to date, outperforming corporate bonds, which are up just under 8%, and municipals, which are just up slightly over 4%. So, taking a look at where we are, what did President Trump do over the weekend? He signed some executive orders, one that extended federal unemployment benefits at a rate of $400 a week from the expired level of $600. Somewhat controversial is that that $400 includes not only some federal money, which is being scrutinized because Congress has the power of the purse, but also includes state money as well, which is different from the original $600 a week level that was all federally provided previously. President Trump also announcing cuts to payroll taxes, and these are the taxes that come out of your paycheck every week. Now, this is a temporary measure because those monies that will be cut is not a permanent cut. It's you will owe it when you will pay your taxes next year. It's just that you'll see more money in your paycheck at the moment. And then the third major pillar of what President Trump announced is that he will look into what the federal government can do to stay evictions for people in residential housing. Not clear what power the executive branch has, but one of the grave concerns out there is with this stimulus money expiring for unemployment benefits, and with the moratorium on evictions ending, it puts a lot of people in their homes into jeopardy of possibly being evicted, and that is something that certainly scares lots of Americans and President at least raising the issue of the seriousness of it with him saying he will examine that issue. So, what else going on this morning? We have earnings from Berkshire Hathaway. They announced that they had record earnings, largely due to the performance of their stock portfolio, specifically Apple being a huge contributor to Berkshire's earnings, and those record earnings as a result of the equity portion of Warren Buffett's portfolio. At the same time, Berkshire Hathaway did announce a $9.8 billion write-down and 10,000 job losses on its Precision Castparts aircraft parts unit, as Berkshire Hathaway is speculating that we will not see a quick turnaround in aviation. Also in the news is Amazon and Simon Property Group, SPG, which is one of the largest mall operators in the United States. Reports that Simon has been talking to Amazon about turning some of its department store sites like JCPenney and Sears into Amazon distribution centers. There's also been some discussions between Amazon and Simon about mutually getting together to buy out occupied space from retailers and jointly owning them for those distribution centers. So Simon getting creative here as it's getting more and more challenging to get people back into malls, even if the pandemic fades and people feel comfortable going back to normal life, so to speak. It's possible that normal life may not include as many trips to the malls as we've gotten even more accustomed to shopping online. Finally, talking about online shopping, United Parcel Service, UPS, saying they plan to impose big fees on large shippers sending significantly more packages through its system during the holiday season amid the coronavirus pandemic. UPS said new fees could total as much as $3 a package for ground shipments and $4 a package for air shipments bound for residences. UPS saying these surcharges will apply from mid-November until mid-January and are designed to apply to customers that send more than 25,000 packages a week. What's interesting is if your volumes increase significantly, these costs also ratchet up. So if you send more than 110% of what you normally send, you're subject to one ratchet up in prices. If that number goes to 200% more, that price increases more. And if you send 300% more, that price goes even higher. So we may see some of that free shipping that we've gotten used to maybe become more limited this shopping season. Couple of stories from Barron's. Talk about the presidential election. This is the headline article in Barron's. And less than 100 days away, what does it mean for the stock market? One scenario is kind of the status quo. President Trump's reelected, Republicans keep the Senate, Democrats keep the House, and Barron's in this scenario feels that this is somewhat a status quo in terms of, not necessarily in terms of where we go for financial markets, but in terms of who winners and losers look like. It doesn't change the outcome significantly. Another scenario that's getting some further examination as polls indicating that Democrats, at least at the moment, seem to be polling better than they had previously been polling, and this would be a Democratic sweep of the White House as well as the Senate and the House. What that potentially would mean is higher taxes. President Biden has proposed, if he were elected, reversing half of the Trump corporate tax cut, which would raise the tax to 28%. He's also proposed introducing a Social Security donut hole by leveling Social Security payroll taxes on wages above $400,000. He's also said he would like to restore the top personal income tax bracket at 39.6%. Remember, President Trump lowered it to 37%. He would phase out the 20% deduction on qualified business income. He would reinstate the deductions for those earning above $400,000. Also, Biden administration would like to eliminate preferential treatment of capital gains and dividends for high earners. They'd like to raise taxes on income earned by foreign subsidiaries of U.S. companies, and they would like to tax unrealized capital gains at death. All of these proposals, if they were to become law, could certainly influence financial markets, and many prognosticators coming up with all different scenarios, some pretty negative and some moderately positive, depending on your viewpoint. Barron's did come up with two groups of stocks that they think could do well, regardless of who wins the election or what the House or the Senate look like. So perhaps those may make the most sense for those of us who don't have a crystal ball. And those two segments are clean energy and infrastructure. Let's start with infrastructure, kind of the most obvious. Both candidates have suggested revitalizing U.S. infrastructure. Biden has proposed $1.3 trillion in spending on highways, bridges, and airports over the next 10 years. President Trump is reportedly considering $1 trillion in infrastructure spending. So Barron's suggesting two ETFs in that space, PAVE, P-A-V-E, and the iShares U.S. Infrastructure Fund, symbol IFRA. The other sector that should continue to do well, according to the Barron's article, is clean energy stock prices. This may seem counterintuitive, given that President Trump has been very favorable or favorably inclined towards fossil fuel companies. Nevertheless, Barron's pointing out that the march towards clean energy is now a march that is self-sustaining. In other words, clean energy does not need the federal backing that it previously did in order to compete with fossil fuels. And if you look at the performance of clean energy has performed very strongly the last few years, despite the fact that the Trump administration has had favorable policies towards older energy or fossil fuels. So Barron suggests taking a look at two ETFs. One is QCLN, Quality Charlie Lucky November, and the other is PBW, Paul Boy Whiskey. When you look at QCLN, this is a First Trust ETF. This ETF has a heavy weight towards the stocks it likes, so it is not a market cap weighted index. Big positions in companies like Tesla, TSLA, make it a little bit more volatile, but has been a help to its performance of late. The other one I mentioned, PBW, which is the Invesco Wilder Hill ETF. That one is equally weighted and also tends to tilt towards smaller, cheaper stocks. Both have had strong returns over the past several years, and Barron's thinks that success will continue into the future. Going to mention one other article, and then I'll talk a little bit about the bond market. I spoke to Brad this morning. He is traveling this morning, so won't be joining us. Brad usually gives us his market expertise on the bond market, and I will try and do as good a job as he does, give a little update there. But first, one other thought, and this has to do with news from Walt Disney last week, and Walt Disney announcing that Mulan is coming to Disney+. Mulan was expected to be one of Disney's blockbusters 2020, so significant that Disney has decided not to go to theaters and is going to be moving Mulan to Disney Plus for release. We'll be charging $29.99 or basically $30 to watch Mulan on Disney Plus. You got to be a subscriber of Disney Plus in order to watch it. Disney announcing last week that they're up to 60 million people who are subscribers. And it's interesting, the economics of going directly to the streaming channel. Disney potentially could keep as much as 85% of sales through Disney Plus versus 55% if they release it in theaters. So you don't need quite the success or the numbers that you see when you hear how movies did in the theaters in order for it to be an equal success on a streaming service. Also very significant when you see a company like Disney saying that they're going to change the distribution channel even though we're in a pandemic. It is very possible that they're exploring this channel for a more permanent situation for releases going forward, even though Disney has said that they don't expect to use this channel once the pandemic ends. Many in the entertainment industry are questioning whether or not even Disney can swim against the tide of technology and the future, and the thought process becoming increasingly that if this is a success, that we may see more movies come directly to our homes. So moving on to the bond markets, spoke with Brad this morning. Brad feels strongly that the municipal market remains, in terms of relative attractiveness, the most attractive of the fixed income markets. I concur with those thoughts. You are continuing to see municipal bond yields at over 100% of Treasury yields. You're seeing 30-year municipal bond yields, AA, AAA paper with yields to maturity of 170 to 175. When you compare that to the 10-year Treasury at 140, 145, those levels look attractive. Brad also emphasizes that even though we're talking relative attractiveness, it is still tough to swallow getting 170, 175 for a bond going out 30 years, even if the Treasury yield is significantly lower, which is impacting demand for bonds. But nevertheless, as individuals and institutions become more and more used to prolonged low interest rates, municipals are getting more and more looks from investors as well as crossover buyers like insurance companies because of their relative attractiveness. Brad also emphasized that he is a big believer in sticking with quality. If a municipality or a revenue bond was having any issues pre-pandemic, it is very possible and likely that they will be having even greater issues post-pandemic. So the thought process is stick with high-quality bonds with reliable cash flows, bonds that are in neighborhoods where the tax base can support the payments on the bonds, even if we become further stressed in the economy. Same thought process. Stick with issuers like water, essential services like water and power, and be more cautious about things like transportation bonds, which includes parking garages, which includes tolls, certainly includes subways and bus lines. Uncertainty still there, and the question then becomes, are you getting paid enough for that uncertainty? That's everything I've got.
Thank you for listening to Mr. Keith Lanton. For more podcasts, please visit our website, www.lanternwa.com.